In today's incredibly fast-paced market, staying truly well-informed on specific companies, I mean, it can feel like a full-time job, can't it?
Oh, absolutely. It's just this relentless torrent of news, earnings reports, analyst calls.
And let's be honest, a fair bit of noise, too.
Exactly. Noise.
If you're an investor navigating the complexities of the Indian stock market, you definitely know how daunting it can be to cut through all of that, to find the genuine signals. But what if you could get a real shortcut? A deep dive, custom-tailored just for you, cutting through that noise to deliver exactly what matters most for your investment decisions.
Well, that's precisely our mission today, isn't it? We're embarking on an in-depth exploration of Divgi TorqTransfer Systems Limited, or DTTS, as we'll probably call them.
Yeah, DTTS, a significant player in the automotive drivetrain and transmission space, listed on both the BSE and NSE.
And for this journey, we've pulled from some really key sources. Their recent Q4 and full year FY25 earnings call transcript, that was from June 2nd, 2025, and also their detailed business overview document.
Right. And our goal is clear: to extract the most important nuggets of knowledge, insights, and maybe even some surprising facts that genuinely impact your perspective as an investor in the Indian stock market.
Definitely. We're not just summarizing numbers here. We're trying to uncover the strategic narrative, what's really going on behind the figures and what it implies.
We'll unpack their recent performance, dissect their strategic moves, and explore what their future outlook truly means for your investment decisions, looking beyond just the raw numbers to the underlying story.
And the strategic implications, not just for the company, but maybe for the broader Indian auto ancillary space, too.
Okay, so let's start with the big picture. FY25 for Divgi TorqTransfer Systems. Jitendra Divgi, their MD, described it as a year of mixed outcomes. Now,
Mixed outcomes, yeah.
if you just glance at the top-line revenue numbers, mixed might feel like, well, a bit of an understatement because revenue was down.
It was, yeah.
But he quickly pivoted to calling it rich with progress on various business opportunities. So how do we reconcile that? Is this just, corporate spin, or is there a genuine signal here for investors that goes beyond the headlines?
That's a great question. And I think that's where the crucial nuance lies for an investor. It's absolutely key. When a company acknowledges a steep decline in the top line,
Which was 12% in this case, right?
right, 12% revenue drop, yet they proudly state they remain profitable at levels implicitly and explicitly promised, even amidst, as they put it, persistent industry headwinds in core segments like transfer cases and EV transmissions. Well, that's not just spin.
Right.
That's a testament to some deep operational resilience. It tells you management has exceptional control over their cost structures. They can hold margins even when the market isn't cooperating.
Oh, yeah.
Think about it.
Right.
Many companies would see their profits absolutely cratered with that kind of revenue hit. Divgi didn't. And that speaks volumes about their internal discipline. It's a qualitative factor, really far more valuable than just a single year's revenue growth when you're assessing long-term investment viability.
So it suggests they aren't just riding market waves, they're building a ship that can actually withstand storms.
Exactly. So even with revenue taking that hit, they kept their promises on profitability. That points to a really strong operational management team, doesn't it?
It really does. A resilient business model capable of preserving margins even during tough times. This speaks volumes about their internal discipline, their ability to adapt.
Which, for you, the investor, translates to a potentially more stable and predictable business, even when things get rocky in the wider market.
That makes perfect sense. For your investment perspective, this ability to protect margins in a downturn is, like you said, a critical indicator of business quality.
Absolutely. It shows they're not merely a beneficiary of a booming market, but can also hold their ground when conditions are tough. Demonstrates robust cost control, strategic agility.
Okay, let's dig into the full-year financials for FY25 then, because those numbers should provide the concrete evidence for this resilience narrative.
Right, let's look at the details.
Total income stood at 240 crore. Now that represents a 12% year-on-year decline from 273 crore in FY24.
Yep, 240 crore.
And the company explicitly attributed this primarily to subdued domestic demand in transfer case. That's a pretty significant drop on the top line.
Indeed, that 12% revenue decline is certainly significant. It's something an investor would immediately flag, no question.
But when we look at profitability, the picture becomes, well, more nuanced, as you said.
Exactly. Let's look at EBITDA. That's earnings before interest, taxes, depreciation, and amortization. basically a measure of core operational profitability.
Right.
It stood at 58.6 crore, which was down 19% year-on-year. This resulted in an EBITDA margin of 24.4%.
Okay, 24.4%. Still pretty solid.
And management actually pointed out that this margin would have been over 25% if you adjusted for some one-time marketing expenses related to the Auto Expo.
Hold on. Over 25% EBITDA margin, even with a 12% revenue drop. Wow. That's genuinely impressive cost management right there.
It really is. It indicates strong control over operational costs and a business model that isn't entirely reliant on sheer volume for profitability. Signals a lean operation.
Okay, so what about the bottom line? Profit after tax, PA.
Right, PT, the net profit. This came in at 24.4 crore. That showed a steeper decline, 39% year-on-year.
Ouch, 39%.
Yeah, resulting in a pay margin of 10.2%. Now, the management attributed this sharper decline primarily to higher depreciation expenses arising from strategic capital investments and made for future growth.
Ah, okay, so that higher depreciation, it isn't necessarily a negative then, is it? For an investor, that's crucial to understand.
Exactly. It's a non-cash expense, right? It's a result of significant investments aimed at future scale-up, like the new export-oriented machinery they mentioned.
So it can be seen as a sign of forward thinking, building for the future, rather than a symptom of operational weakness or shrinking demand.
Precisely. It's important for investors to distinguish between a drop in PAT due to operational issues like, say, soaring raw material costs or inefficiency, versus a decline due to planned strategic investments for future capacity. This is clearly the latter.
Got it.
And on the shareholder return front, the board also recommended a final dividend of 2.6 per share.
Okay, 2.6 per share. A tangible return even in a challenging year.
Yep. Shows commitment to shareholders.
And speaking of capital, they also updated on capital deployment from their IPO proceeds. At 170 crore earmarked for CapEx capital expenditure, the money for assets.
Right, for buying and upgrading equipment plans.
64 crore has been deployed to date, with 27 crore spent just in FY25. They describe this as a focused and phased approach towards building future-ready capacities.
Focused and phased.
Yeah.
So they're not just throwing money at it. It sounds like it's a strategic deployment, probably tied to specific project milestones and demand forecasts.
Makes sense. What about capital efficiency metrics, ROCE and ROIC?
Yeah. Return on capital employed, ROCE, was 5.6%, and return on invested capital, ROIC, was 4.2%. Now, those numbers are currently quite low.
5.6% and 4.2%. Yeah, not great on the surface.
No. ROCE measures profit from capital employed. ROIC look at returns from all capital invested. Both indicate efficiency in using capital. However, management explicitly expects these, quote, to strengthen in the coming years as the benefits of operating leverage begin to unfold.
Operating leverage. So as the new capacity gets utilized more, the fixed costs get spread out.
Exactly. Once the new capacities from their CapEx investments start producing at higher volumes, the fixed cost will be spread over a larger revenue base, which should significantly improve these returns. It's a common trajectory for companies making big growth investments.
Okay, so for you as an investor, it signals that these low numbers are likely temporary, tied to the investment cycle, not a fundamental problem.
That's the interpretation, yes. It's something to watch, but understandable given the context of expansion.
So despite the top-line pressure, maintaining profitability above 24% EBITDA margin, over 10% PAT margin in that environment, that's a really strong indicator of cost discipline and a robust business model.
Absolutely. And that higher depreciation, as we've discussed, is a direct result of investments aimed at future scale-up, not a sign of fundamental weakness.
Which brings us to a critical question for any investor looking at this stock now. What about the most recent performance, the very latest picture?
Right. Management highlighted Q4 as a strong and encouraging turnaround, marking the beginning of recovery. And this sequential rebound, quarter on quarter, is often a more powerful signal for near-term momentum than a full-year comparison, especially after a tough period.
That's the part that really gets an investor's attention, isn't it? That sequential improvement.
Definitely.
So quarter-on-quarter total income grew by nearly 12% to 64 crore from 57.5 crore in Q3 FY25.
Yep, a solid jump from Q3.
EBITDA rose 7% quarter-on-quarter to 14.5 crore.
Good to see.
And P8, while it remained flat quarter-on-quarter at 5.3 crore, at least indicates a stabilization after that full-year decline.
Right. Holding steady is better than continuing down.
Yeah.
If we connect this to the bigger picture, this sequential recovery is a critical signal for you, the investor.
How so?
Well, it suggests that the proactive measures and strategic initiatives the company undertook, maybe optimizing production, securing new orders, streamlining things are beginning to yield positive results.
Okay.
It translates into what they called a healthier and more robust order book. This rebound in the final quarter suggests that the worst might be behind them for this particular cycle.
So it lays the groundwork for the more optimistic future outlook management provided for FY26. It's like the first green shoot after a tough season.
Exactly. It's not just a hopeful statement, but a visible, tangible trend in the most recent quarter. That's a good sign for anyone looking at the stock.
Okay, great. Now let's really dive into the individual business segments, because this is where we can unpack the specific growth drivers and strategic shifts happening at DTTS.
Yeah, let's break it down, starting with their traditional stronghold, the transfer case segment.
Right, their core business historically.
This segment faced, well, significant headwinds in FY25. They saw a significant drop in volume, particularly from domestic markets. That led to a substantial 29% decline year on year.
29%?
Yeah. It reflects broader industry slowdowns in the traditional four-wheel drive and all-wheel drive vehicle segments within India. Those were hit by fluctuating consumer demand, broader economic factors.
Ouch! A 29% decline in volume is pretty substantial, especially for a core product. But despite that, they did mention some bright spots and surprising resilience, didn't they?
They did. They saw an improved per-unit realization, basically, getting more money for each unit sold, due to a favorable sales mix in defense orders. And get this, their gross margin actually expanded from 61% to 63%.
Wait, gross margin up when volumes are down 29%. How on earth does a company manage that? What does that tell us about their pricing power?
That's a fascinating point, isn't it? And it speaks directly to their strategic positioning. This improvement in per-unit realization and gross margins, despite lower volumes, was driven by something called volume-adjusted pricing mechanisms.
Okay.
These are embedded in their long-term contracts with OEMs. It basically means that if volumes drop below a certain threshold, the price per unit actually increases to compensate.
Oh, that protects their profitability. Smart contracting.
Very smart. Plus, the inclusion of defense orders, which typically command higher margins and offer more stable demand, contributed to that more favorable sales mix. It added resilience during the downturn in their traditional auto market.
So it showcases strong contract terms and a sophisticated approach to managing customer relationships, a real testament to their negotiating power and strategic choices.
Definitely. So what about the outlook for FY26 in this segment? Is this a segment that will continue to face challenges, or is there a recovery on the horizon?
Yeah, what's next?
Management expects a recovery in volumes for FY26. They're basing this on the latest production forecasts and customer schedules they're seeing.
Okay, so some optimism there. Where's the recovery coming from? Just domestic rebound?
Not just domestic, and this is key. Crucially, it's anticipated from new orders from Japanese and Korean OEMs, and also from expanding aftermarket opportunities in the U.S.
Ah, international expansion and aftermarket. That signals a critical strategic diversification for the transfer case business, right? Moving beyond just relying on the domestic market.
Exactly. They're definitely not putting all their eggs in the domestic basket. This continued global expansion and traction in the U.S. aftermarket, it sounds very promising.
They even said it presented very interesting opportunities to significantly enhance the resilience and growth potential of our revenue streams. This global pivot seems like a very smart move.
Agreed. And we mustn't overlook the defense business highlight either. Their transfer cases were successfully deployed for Indian Army vehicles and were apparently in active combat service during Operation Sindoor. While perhaps smaller in overall volume, this segment clearly added resilience and diversification to their core business. And importantly, it proved their products in highly demanding, mission-critical environments.
That's a strong validation. So for you as an investor, the ability to improve per-unit realization and gross margins despite that volume decline showcases real pricing power and a strategic sales mix.
Precisely. And the focus on global expansion U.S. aftermarket, Japanese Korean OEMs diversifies risk away from potentially volatile domestic demand. It indicates a proactive rather than reactive approach to market challenges, opens up new revenue streams.
Okay, let's move on to the EV transmission segment. Obviously a big buzzword right now, high growth area, lots of focus.
The future, supposedly.
Right. But the Indian EV segment faced additional pressure in FY25, didn't it? Macro headwinds, infrastructure limitations, and that persistent range anxiety among consumers.
Yeah, it wasn't exactly smooth sailing for the broader EV market in India, but DTTS still saw a marginal volume improvement of 6% year-on-year in their EV transmission business.
Okay, 6% growth during a slowdown for the overall EV market.
Right.
That's certainly commendable. Not explosive, but positive.
But the real story here for investors, I think, lies not just in the current growth, but in their key growth drivers in future partnerships. Their deepening partnership with Tata Motors is particularly notable.
How so?
They're expanding their supply across multiple Tata models, from the little Tiago, they said, all the way to the Curve Coupe.
Okay, that's a wide range.
And revenue generation from these new programs is expected to begin in Q2, with production volumes scaling up thereafter. So that suggests a broadening and deepening relationship with a leading Indian EV player.
That's exciting, getting into more models with a market leader like Tata. But it's not just about Tata, is it? They mention others, too.
No, definitely not. They're also actively developing business with Mahindra on a micro truck and exploring opportunities with other Japanese OEMs as well. It paints a picture of a company actively seeking to diversify its customer base within the EV space.
Okay, diversification again. Now, this raises a very important question. How significant is their forecast of at least 50% revenue growth in FY26 from new EV transmission products?
Yeah, 50% is a big number.
Especially when they emphasize it's a fairly conservative forecast. I mean, in the context of an overall market slowdown and range anxiety, how realistic is that?
Well, that's the key point. This 50% growth, if it materializes, isn't just about market recovery. It seems to be a strong indicator of new program wins and market share gains for DTTS.
So it's not just the tide lifting all boats, it's them grabbing a bigger slice of the pie.
That appears to be the implication. And what's even more compelling, especially for a global investor perspective, is the fact that DPTS has been shortlisted as one of 3 global candidates from an initial field of 15 international players to supply gear sets for one of America's leading OEMs in the EV space.
Wow, one of 3 globally from 15.
Yeah, for vehicles distributed across global markets. This highlights an extremely strong competitive position and technological prowess that extends far beyond India.
That is a massive validation. Being among the top 3 globally for a major U.S. OEM for vehicles that will go global, that's a serious vote of confidence in their technology and capability.
Absolutely. It suggests their EV solutions are genuinely world-class. It's a testament to their engineering capabilities on a global scale.
Okay, very impressive on the EV front then, especially the potential pipeline. Now, let's shift gears again to the component segment. This sounds like an impressive export-led growth story based on the outline.
It absolutely is. This segment delivered a significant 41% year-on-year growth in FY25. That's huge.
41%.
And it was primarily driven, as they said, by a solid resurgence in export markets. This indicates a very successful pivot towards international demand.
Wow, 41% is a huge leap. And the scale-up in export revenues is equally dramatic, isn't it? From a very modest 3.5 crore in FY24 to around 11 crore in FY25.
Yeah, that's nearly a 3-fold increase in a single year. For you, the investor, this is a clear sign of a successful strategy unfolding right now.
Definitely. And their ambition and forecast for the future are even more aggressive, right? They expect exports to have a double-digit percentage to overall revenues by the end of FY26.
That's right. With export revenue forecasted at a substantial 70-90 crore in FY26.
70 to 90 crore, that's a monumental leap from 11 crore. That signals very strong conviction in their global strategy.
It does. And they've also secured production approvals for 8 new components across a very diverse set of geographies: Korea, Europe, United States, and Mexico, plus a robust pipeline in Japan, Thailand, China, and India.
So what does this all mean for you as an investor? This component segment is clearly a powerful engine for diversification and growth for DTTS.
Absolutely. The dramatic increase in export revenue and those ambitious targets signal a highly successful strategy to tap into global demand. They're clearly becoming a more global player, which, again, de-risks their business from purely domestic market fluctuations.
And here's where it gets really interesting for the long-term outlook, I think. The underlying dynamics driving this export resurgence.
Yes. Management spoke quite a bit about this. They talked about the tumult and anxiety due to U.S. tariff uncertainty, particularly regarding China.
Right.
However, they highlighted what they called a strategic sort of recognition in the United States that for far too long they have put all their eggs in one basket, meaning China.
The China plus one strategy we hear so much about.
Exactly. This is leading to a significant and accelerating shift towards non-China sourcing. And India, they pointed out, continues to enjoy at least a 25% import duty advantage over China.
That's a huge competitive edge for Indian manufacturers like DTTS. So U.S. customers are now actively creating, as they put it, dedicated focus on India sourcing now.
Yes, this isn't just a transient trend, it seems. It's a strategic policy shift driven by geopolitical realities and supply chain resilience objectives. It's potentially excellent news for Indian manufacturers looking to scale globally.
It really feels like a moment for Indian manufacturing on the global stage.
It could be. And it's not just the U.S.
Yeah.
Interestingly, China itself presents an opportunity for DTTS to service low to medium volume requirements that the big Chinese Tier 1 suppliers find difficult to fulfill because they're so focused on gargantuan volumes. This allows DTTS to carve out profitable niches even within China.
Fascinating.
Furthermore, from Japan and Korea, global leaders like Toyota, Honda, and Hyundai are showing a renewed strategic focus on India sourcing, recognizing India's growing capabilities and cost efficiencies.
So this detailed insight into global sourcing shifts provides a strong long-term tailwind for DTTS's export ambitions.
Absolutely. The Make in India initiative, coupled with this global supply chain diversification trend, is clearly gaining traction on a global scale, directly benefiting companies like DTTS.
It's not just about cost anymore, is it? It's about strategic diversification, capability, resilience for these global supply chains. Okay, now let's talk about the really cutting-edge stuff. Next-generation transmissions, state-of-the-art automatic and dedicated hybrid solutions. This sounds like a major leap forward.
Yeah, this segment really represents the company's commitment to cutting-edge technology and future relevance. Management firmly believes electrification is a reality, no surprise there, but they see strong growth globally, not just in battery electric vehicles, BEVs, but also critically in hybrids.
Hybrids are key too, then.
They emphasize that dedicated hybrids form a very important component of this segment and will play a significant role in the transition, especially in markets like India, where infrastructure or cost might slow down pure BEV adoption.
Okay, makes sense. And what kind of tangible progress are they making on this front? Because developing these high-tech transmissions can be a long and, frankly, expensive process.
True. But they've made concrete strides. They've zeroed in on a design architecture, apparently, and they've completed simulations of fuel efficiency improvements.
That's critical for India, right, with the upcoming emission norms.
Absolutely. India is facing what they said was 2 generations of emission norms in the next 7-8 years. So improving fuel efficiency will be paramount for vehicle manufacturers. They've also completed the first phase of our feasibility study on dedicated hybrid transmissions.
Okay, feasibility study done.
And, most impressively, they have the first prototype of our dedicated hybrid transmission in hand, with further validation and testing underway.
A prototype in hand. That's a significant step beyond just R&D plans. That shows real commitment and execution capability.
It really does. Moving from concept to physical reality is a big milestone. But it's not just about their own internal development. They're also looking at strategic partnerships for high-volume automatic transmissions, right?
Yep.
Which could really accelerate their market penetration.
Right, the partnerships. What's happening there?
Feasibility studies are actively underway with a top Japanese OEM and a European OEM of great renown to potentially produce high-volume automatic transmissions in India.
High volume, made in India. That's big.
It is. The Japanese study, in particular, is for a market leader in the ASEAN region for a new transfer case. Management called this a revolution, given the traditional conservatism of Japanese OEMs in sourcing core powertrain components from outside their established ecosystem, especially from India.
A revolution. Strong words.
Yeah. These studies are comprehensive, aiming to assess the financials, the amount of investment needed, and whether the financial standards are achievable. The Japanese study is slated for conclusion in June, July.
June, July. So that's basically right around now. We could hear something soon.
Potentially. So if these studies ripen into concrete partnerships, especially for high-volume automatic transmissions, that could be a genuine game changer for Divgi TorqTransfer Systems.
What's their long-term vision here? Are they just looking to manufacture these things, or is it something more?
Their long-term goal seems far more ambitious than just manufacturing. It's to localize high-tech AT and hybrid transmissions for Indian and global markets.
Localize.
And this is about moving beyond just building to print, manufacturing exactly according to a client's design, to actually assimilating technology to engineer then the next generation products.
So owning the technology, developing it further themselves.
Exactly. For you as an investor, this segment represents the company's commitment to cutting-edge tech and future relevance. Successfully finalizing a high-volume AT program, especially with these global OEMs, would be a transformative event. It could significantly solidify their position in advanced powertrain solutions and dramatically increase their addressable market.
And management even hinted at a great announcement before December, didn't they?
They did. That's a clear signal for investors to watch this space extremely closely. This strategic move anticipates future market needs, future regulations. It positions DTTS at the forefront of automotive innovation in India, potentially.
That's a huge potential catalyst to keep a very close eye on. It speaks directly to the forward-looking, technologically driven nature of their strategy. Okay, now let's talk about the foundational elements, the operational excellence and strategic partnerships that allow all this impressive growth and innovation to actually happen.
Right, the unsung heroes, often.
These are often the bedrock of a company's success, aren't they?
Absolutely. These are indeed the bedrock of sustainable profitability and competitive advantage. Beginning with strategic collaborations and licensing, there are license renewal with BorgWarner signals a continued robust strategic alliance.
BorgWarner, the global giant.
Yeah, this provides DTTS strategic access to BorgWarner's top management and, crucially, acts as a key enabler for a lot of our component exports.
So it's not just a paper agreement, it's a living partnership that opens doors and generates significant international business, a symbiotic relationship.
Exactly. It validates DTTS's capabilities on a global stage. And they've also received significant OEM recognition recently, haven't they?
Yes. Supplier of the Year awards from both Toyota and Mahindra in the last 12 months. That's pretty prestigious for an auto ancillary firm in India.
It's more than just an accolade, though. It's a critical endorsement from market leaders like Toyota and Mahindra. These awards reflect deep trust, consistent quality, tight integration into their customers' supply chains.
Which translates directly into sustained business opportunities and enhanced market credibility, right? Reinforces their position as a preferred partner.
Absolutely. Management highlighted that this fulfills their vision to become recognized as a global brand coming out of India in the area of drivetrain components and systems. This validation from industry giants is incredibly valuable for you as an investor, underscores the company's reliability and reputation.
Okay, moving to operational excellence itself. These are the minute details that often get overlooked but have a monumental impact on the bottom line and reputation. For instance, achieving 0 unsafe incidents across all 4 plant locations in FY25.
Yeah, that's not just good for employee welfare. It's excellent for business continuity and risk management.
And their quality metrics. Those sounded outstanding.
They really are. They consistently maintain single-digit customer PPM levels. For anyone unfamiliar, PPM stands for parts per million, so it indicates the number of defective parts in a million. Single-digit PPM means incredibly few defects.
Like how low?
For instance, their Bosari plant was at an astonishing 3 ppm, Sherwall at 2 ppm on EV transmissions. Even more impressively, they boast a 0 ppm track record on quality for our export shipments to the United States of America.
0 ppm for U.S. exports. Wow.
And they got a 0 ppm award from Toyota and the Proprietary Powertrain Supplier of the Year award from Mahindra and Mahindra. It speaks volumes about world-class quality control and precision manufacturing.
0 ppm for the U.S. and awards from Toyota and Mahindra.
Right.
Those are truly world-class standards for any manufacturing company, let alone one from India. That's remarkable.
It really is. And 100% on-time delivery throughout the year is also critical.
Yeah, keeps customers happy, maintains those strong OEM relationships, secures repeat business, prevents costly production halts for their clients.
And these operational details directly impact the bottom line for you, the investor. High quality reduces warranty costs, improves customer stickiness, and is absolutely essential for securing and sustaining those ambitious export opportunities we discussed.
Right.
Their disciplined 1.44% cost reduction through supplier cost savings realization, Kaizen process improvement, and efficiency initiatives. It directly boosts margins. Even if it sounds like a small percentage, these incremental gains accumulate into significant profitability over time.
Every bit counts.
Exactly. Furthermore, their investments in new export-oriented machinery were successfully commissioned and are now operational. That indicates their readiness to meet that increased global demand we talked about.
Good timing.
And the Sherwall plant also received the IGBC Green Building Certificate, reflecting a commitment to sustainability, which is an increasingly important factor for global OEMs and, frankly, for many environmentally conscious investors, too.
So these are the unsung heroes of sustainable profitability. The meticulous attention to safety, quality, delivery, cost management. It allows them to punch above their weight, really.
Well put. And speaking of growth, they've even brought in new leadership specifically to accelerate that, right?
Yes, the appointment of Satvinder Singh Sabharwal as Chief Growth Officer, that sounds very strategic.
It is its newly created role,
Yeah.
and he brings over 2 decades of automotive industry experience to the table. His stated goal is clear: to drive value to our shareholders through growth by exploring new markets for our existing products, as well as looking for new products for our existing markets. It's about finding growth from all angles.
So why should you care about this as an investor? Well, the creation of this dedicated role and the caliber of the individual, it underscores the company's aggressive growth ambitions.
Right. It shows their commitment to identifying and capitalizing on new opportunities. This proactive approach could unlock significant shareholder value, ensuring future growth isn't just organic, but also strategically driven by dedicated leadership.
It signals a disciplined and focused approach. They're not just waiting for opportunities, they're going out and actively hunting for them with a dedicated team.
Exactly. It's a significant signal of intent.
Okay, let's look ahead then. What's the road ahead for DTTS? What are their targets, their grand vision, and what potential catalysts should we, as investors, be watching for in FY26 and beyond?
Their strategic direction for FY26 seems very clear and focused. Key focus areas include aggressively scaling up in EV transmissions and component exports.
The 2 big growth engines we discussed.
Right. Consolidating their leadership in four-wheel drive, especially with what management called the blockbuster product, the 5-door Thar from Mahindra, which is expected to drive significant volumes.
The Thar effect.
And critically, finalizing those high-volume automatic transmission programs we talked about earlier, that seems like a top priority.
Those are clear, aggressive targets, and they're not shying away from projecting significant growth, are they? Management is targeting 50% growth in FY26.
50%, yeah. Led specifically by EV, exports, and that recovery in 4WD. It's a substantial jump from their FY25 performance.
Is there any early indication if that's achievable?
Well, what's particularly encouraging for you as an investor are the early Q1 FY26 indications they shared. Management gave an optimistic outlook, stating that the rebound in Q4 it's just like a light appetizer.
A light appetizer, I like that.
Yeah, and he added that the first 2 months of this quarter has been even better than that.
Okay, so positive reinforcement suggesting Q4 wasn't a fluke, but maybe the start of a sustained upward trend. That provides some concrete near-term validation for their ambitious FY26 targets.
It does. It adds credibility to the forecast. And for the long term, they have a very clear ambition, marching towards a 1,000 crore revenue milestone.
1,000 crore, that's a significant scale up from their current 240 crore run rate.
It's huge. So what does this all mean for your portfolio? These are clear, aggressive targets backed by early positive indicators. The 1,000 crore target sets an ambitious long-term growth trajectory. For an investor, it outlines a compelling growth pathway, indicating the company isn't content with its current size, but is actively pursuing significant expansion.
And speaking of clear signals, Jitendra at Divgi explicitly stated, and you mentioned this earlier, I really look forward to having some kind of a great announcement before December regarding the next generation automatics.
That's about as direct a hint as you get from management. It's a direct prompt for investors to watch this space closely.
And if we connect this to the bigger picture, achieving a significant win in the automatic transmission space, especially with a global OEM, that would be a major re-rating event for the company, wouldn't it?
Absolutely. It could solidify its position in advanced powertrain solutions, moving it beyond traditional components into a high-tech, high-value segment. This could fundamentally change how the market values the company, potentially leading to significant upside for investors. It's a potential game changer.
Okay. Despite all this optimism and these ambitious growth targets, management still maintains a kind of guarded approach, right? Acknowledging global uncertainties.
Yes. They mention things like trade dynamics and the varying pace of EV adoption. They're not blindly optimistic, which is probably wise.
So they're grounded.
Yes. But despite these global headwinds, management remains confident in their strategy and execution. They firmly believe the electrification wave is here to stay in their target markets, even if the pace varies.
So it's a balanced perspective. Acknowledging challenges while maintaining strategic conviction offers investors a realistic but still optimistic outlook.
Exactly. It shows they are not just hoping for the best, but seem to have a well-thought-out plan to navigate potential turbulence.
Okay, so to recap then, we've taken a really comprehensive deep dive into Divgi TorqTransfer Systems today. We've revealed a company that, despite those recent top-line challenges, demonstrates a remarkable operational resilience,
Definitely.
strategic foresight, and clear growth pathways in these high-potential segments like EV transmissions and global component exports.
And for you, the investor in Indian stocks,
Mm-hmm.
DTTS presents a really compelling narrative, I think.
Mm-hmm.
It's a specialized auto ancillary leveraging cutting-edge technology, cultivating strong OEM relationships, and executing a robust global diversification strategy to overcome cyclical headwinds and hopefully secure future growth.
Yeah. The Q4 turnaround, that robust export growth driven by favorable global supply chain shifts, and those ambitious next-gen transmission initiatives. It paints a picture of a company truly poised for significant future growth. And it's all backed by that solid operational discipline we talked about, the quality, the delivery.
It's a fascinating story of an Indian company making waves globally and really redefining its position in the automotive value chain.
So, let's end with a provocative thought for your portfolio.
Okay.
Considering Divgi TorqTransfer Systems' clear intent to localize high-tech automatic and hybrid transmissions and to aggressively expand its global footprint, will it serve as a leading indicator for how specialized Indian manufacturing can truly capture global market share in advanced automotive technologies?
That's interesting. Could DTTS potentially be setting a precedent, a blueprint even, for other Indian ancillary firms aiming for international growth and innovation-led value creation in this rapidly evolving global economy?
It's a question that could really shape the future investment landscape for Indian manufacturing, isn't it? Something to definitely mull over.